Good morning. Welcome. Welcome to Sherry Beckard's second installment of Strategies for the Business Owner. My name is Tessie Eustace. I'm a senior wealth advisor working with clients in the Florida area. I specialize working with business owners and high net worth individuals planning for the future and protecting their wealth. Today's webinar is will cover very valuable strategies in the form of role playing with my colleague Peter Tomasz, who's out of the Washington, D.C.
Thank you, Tessie. As she just mentioned, my name is Peter Tomasz. I'm a financial advisor in the DC office. And for today's webinar, I'll be playing the role of a client, in this case, Steve. A little background information, the role play assumes that I'm already Tessie's client, and this is a second meeting that we're having as a follow-up in advance to me selling my business. We'll start with a recap of the last meeting, how the sale of my business impacts my financial plan, and finish with 3 tax saving strategies, all centered around with the sale of my business. They're going to include a 1031 or like-kind exchange, a donor advised fund for charitable gifting, and the use of a solo 401k to offset my consulting income. So with that, I'll turn back to Tessie.
Perfect. Thank you, Peter, for that summary. To go back to what Peter mentioned, our clients' names are Steve and Linda. They're business owners that are getting ready to sell their business and retire. We already had the initial meetings to flesh out their goals and understand their current situation. So as we mentioned during the last meeting, Steve, we talked about that you were getting ready to retire and that you were considering a couple of offers for the sale of your business. How is that coming along?
Yeah, Tessie, thank you. It's coming along well. I have an offer in place. We're going to sell this year. I'm really looking forward to retiring and stepping away and really protecting everything that I've built to date through the growth of my business.
That is great. I also remember you shared with me that you own the building with your partners, but and that the share of the building is mostly fully depreciated. So there would be a significant amount of capital gains from selling the portion of the business. So something we're going to cover today, we'll cover a strategy to address that specific situation. You may recall that last time we took a look at your assets, because as we plan for the future, it's really a combination of how much you have saved, how much you will spend, and the income you will generate. And lastly, but most important, as you invest those assets, what rate of return those assets are going to provide you. So we're going to do a recap over the next couple of charts. But as I think about what we want to cover today, are we still on track to cover these 3 items in terms of, can you really afford to retire, minimize your taxes, and protect? Anything else that I missed that we want to make sure we cover today?
Nope, that's it. That's you're reading my mind with what I want to focus on, and in particular, minimizing my taxes regarding the sale of business.
Right. So you may recall we've worked very closely with your CPA, Doug Cates, and we've worked hand in hand to develop some of these and design some of these strategies. So as I think about the future, we talked about goals in terms of what you estimate your living expenses are going to be for the future. And that's what we have here in terms of goals, about $150,000 per year. You also talked about making sure that we covered healthcare expenses. And I recall last time you were also evaluating 3 properties. I think one was in Florida, the other one was in Texas. How is that coming along for a second home?
It's going well. Linda and I are excited. We have an offer in on a place down in Florida, South Florida. So we're going to be in between two swamps. I'm up here in DC and have a second house now down in South Florida, which will be nice. We have a contract pending and look forward to close in about a month.
Perfect. So I know that you have the down payment. We've already taken that into account in the financial plan. And also, one of the things you talked about is that you want to do some serious traveling over the next few years. And you wanted us to build some money into the budget of approximately $25,000 a year. Does that sound about right?
Yes, that sounds correct. Kind of in the early years of retirement, want to get as much travel, assuming we can in this current COVID world. I see on this page too, Tessie, that there's a donor advised fund to be determined. What is that?
Yeah, so one of the things we're going to talk about more in depth later on, but one of the things that we talked about, if I recall correctly, is that you're contributing about $15,000 to your alma mater and to your church. And you asked me if at all possible, what would it look like if I continue to do that? Would I still be okay? And that's really, the driver of today's meeting. Am I going to be okay? So one of the things that we modeled is, what can I do to continue contributing to the charities I feel passionate about, but at the same time, minimize my tax hit when I sell my business later on in the year. So the donor advised fund is a strategy we're going to talk about later, but I wanted to make sure that we keep that in the, front and center, because I remember you shared with me how valuable, and how important that was to you.
Okay, great.
So we're going to talk about it a little bit later, but we want to make sure that we keep that top of mind. So as I mentioned, what's important in planning for the future is what you have today, how much you're going to spend, and what income sources do you have, and the investment returns that you're going to get from your assets. So after taking into account the $100,000 down payment that you have for your home, your net worth in terms of investable assets is about $2.5 million. You've done a great job through your employer saving for the future. And also Linda, before she retired, saving as well. So in terms of investable assets, you have about $2.5 million.
That's right. And if you recall, Tessie, before you and I started working together, I didn't have any Roth assets. And through your backdoor Roth IRA strategy, I've been able to put away about $100,000 of completely tax-free money. So that's been great.
And that is great, because that is something that would be important, because as distributions come out from a Roth IRA, you do not pay taxes, as opposed to a 401k or an IRA, that distributions will be taxable as ordinary income. So in terms of other assets that you have, we talked about you were evaluating from your partners a buyout of about upfront about $1.5 million for your portion of the business, and about $500,000 for the building. Is that in line, or has anything been modified?
Yep, that is correct and is in line. I've been working through it with Doug Cates, my CPA, and we're good to go there.
Perfect. Now we have, you're almost getting ready to pay off your primary residence mortgage. However, we have built up a second home mortgage for your Florida property. Is that still progressing?
Yes, it is. So that is what it will be, 2.75%, which is awesome, with a $300,000 mortgage on this South Florida residence.
Perfect. And we've built up the mortgage payment in part of those projections. And when you include real estate and insurance, it amounts to about $2,500 a month built into your projections.
Okay, great.
So if we take a look at inflows, what would be some income sources that you would be receiving over your lifetime? So one of the things that we worked with you was to evaluate the best option for Social Security benefits. And because you were the higher income earner and you get additional benefits if you defer, our calculations that we reviewed last time around is that the normal application for your Social Security benefits would increase substantially to $40,000 at age 70. So we have built that in to your retirement projections. And we have Linda receiving her normal retirement benefits at age 66 and a couple of months. So one of the things that we did, and you may wonder, well, why the difference? And one of the strategies that proves very valuable is where the higher income earner delays claiming their Social Security benefits until later. And God forbid something were to happen to you, Linda will be able to step into your benefit and go up to, the maximum allowed, for your age, which would be about $40,000.
So a way to look at it is the waiting until age 70 really allows us to take the bigger benefit over 2 lifetimes as opposed to just one?
Absolutely. And when we say 2 lifetimes, we're talking about your lifetime and when, and hopefully you won't pass away before Linda, but if you do pass away, then Linda picks up her benefit. It wouldn't be twice the $40,000. It will just be one of the benefits for any of you. Does that make sense?
It does. Okay, thanks.
Okay. Then one of the things we talked about as well is that part of your buyout package, you had developed, or they have proposed a consulting contract for 3 years. You getting paid about $150,000 a year. Is that still on the table?
Yes. So part of my agreement in selling the business is that I'm going to consult back for 3 years and work with the CPA team again to figure out what made sense there. And I'll be receiving $150,000 per year through that consulting.
Perfect. So one of the things you shared with me is that as of this point in time, you do not need, the majority of that income. So we're going to talk about a strategy in a couple of charts about how to defer as much as possible so you can reduce your taxes. You mentioned to me that one of your key points to accomplish is reduce your tax liability. That you've given to ultrasound a lot through your lifetime, that you want to figure out ways to minimize that.
Yes. And Tessie, I know right above the consulting income, or I noticed that there's also 1031 income. I imagine this relates to the building that I have too, the $500,000. That $28,345 or $340 rather. That seems like a pretty specific number. Will you have more details on that?
Yes, absolutely. So you recall that last time we talked about your building being worth, your sale of the business being worth about $500,000. At current tax rates, that would translate to about $125,000 tax bill just for that. So we're going to talk about a strategy called a 1031 exchange that is going to help you defer that income tax. And in certain cases, it could even make it go away in its entirety. So the income that you would derive from that strategy is a little bit over 28,000. And I have a chart specifically to talk about that.
Okay, great.
Okay, so if we take a look at your net worth, and the net worth is everything you have minus everything you owe, you have done an excellent job saving for the future. So your net worth today is about $4.1 million. And one of the things that you want to do is you want to ensure that that other assets, business and property of 2 million gets eroded as least as possible. So that's one of the things that we're going to talk about over the next few charts. The liabilities, you're in really good shape. Just the two real estate loans that you will have, your personal property and the second home you're going to be buying in Florida. Okay, so as I mentioned before, one of the things that you asked me is, am I going to be okay? You know, based on what I've saved, based on what I'm going to spend, and how I'm going to invest it, am I going to be okay? So what we do is we do a simulation based on 1,000 different iterations to see the success rate of that simulation. And what this is telling me, and it's the first number you see to the left, is out of 1,000 simulations, 940% of them were successful, that you were going to be able to achieve your goals. What are your goals? The traveling, the buying your home, paying your mortgage, the $150,000 in living expenses. So due to the hard work that both of you have done, you are in very good shape to achieve your goals over your lifetime. Now,
So I
what
have a
is your
94% chance of achieving all my goals, all the spending things that I want to do, including the down payment on the house, given the different resources and income streams like Social Security, the consulting income, and the 1031 income. Given those resources, I can achieve all my goals.
Absolutely. And if you're wondering, well, how long am I going to be, how long are you modeling for me to live? Well, we're modeling you to live to age 92 and Linda to age 94. That's the life expectancy of someone your age and Linda's age today. However, because of the high success rate, should you live to 100, you are going to have sufficient assets to be able to, you know, even continue living, because at the end of the plan, you'd have a significant amount of assets to take you to the end of your plan. If you're probably wondering, well, what does this mean in terms of spending over the next few years? Well, it translates to about $6 million in spending, but because of your income sources and your investable assets, your simulation is extremely successful. Now,
Okay, great. What's the 93%?
Right. So you also asked me, well, what happens if I were to give $15,000 a year during the next 10 years to my alma mater? And what this shows is the probability of success of you being able to donate to your alma mater and to your church. So there's virtually no impact between one and the other. Now, the interesting thing for me is as we run through different scenarios and different strategies, we're going to talk today about being able to continue to donate to those charities you feel passionate about, but be able to deduct that $150,000. In other words, $15,000 times 10 years, being able to deduct it in your high income year when you get paid out for your business. So in other words, you have the flexibility of giving it over 15 years, but you're going to get to deduct it the first year. So we're going to talk about that strategy, and it's called a donor advised fund.
Okay, and just to make sure I understand, so the 94% is my ability to achieve all my goals over my lifetime, and the 93% is adding in the ability for me to gift an extra $15,000 per year on top of all my goals to these charities, but do it in a tax-friendly way that allows me to have a larger deduction in the current
Exactly.
year, in the year that I sell my business?
That's exactly it.
Okay, great.
Deduct now, distribute later. And that's the ultimate tax advantage, because you want to deduct on your high income year, which would be this year, at the end of the year when you sell your business. So one of the things that we discussed during the simulation is your investable assets and ensuring that you diversify your income sources. When I took a look at your portfolios, one of the areas that I recommended is diversifying your portfolio and reducing the exposure or volatility or the ups and downs of your portfolio. So that would mean reducing from total stocks of 70%, which are your more volatile investments, to total stocks of 60%, which equates to having a long-term rate of return of about 7.5%. So the idea here is that you want your portfolio to work for you, but at the same time, not you preserve, you will end up with more in your pocket if you protect your portfolio in the down times. So you want to diversify your portfolio, domestic, international, and across different types of fixed income or bonds that will provide a higher yield. Because as you know, interest rates are not, bonds are not paying much this year, and over the next few years either, because interest rates are going to remain low. So we want to make sure that we diversify that bond portfolio to give you more yield. Does that make sense?
It does, it does. Thank you.
Okay. So one of the things that I'd like to move on now into the part of my presentation is it's probably the next few charts are really the most important charts of our discussion today. And that's what can I do with my real estate to reduce capital gains? Because I understand that it's mostly fully depreciated. And I also don't want to have all my eggs in one basket. Because as you and I spoke, you told me that you could continue owning that real estate with your partners, but you didn't want to have all your eggs in one basket. So you wanted not to have everything in investments, and at the same time, not to have such a large amount in your business. So you wanted to diversify your real estate holdings. So we discussed, you may recall that we briefly discussed, and we discussed it with that case, which is a 1031 exchange, which is a strategy for deferring capital gains when you sell your business. And basically what you do is you exchange it for other properties by type and geography. And what you get to do is you get to defer that capital gains. And to me, one of the freebies, and you hopefully don't ever have to take advantage for it for a long time. But let's say you exchange it for, various properties, and we're going to talk about it later. Let's say you pass away. That gain that you have in that property would receive a step up in basis. So in other words, that $125 tax bill would go away. Does that make sense?
I think so. Do you have additional detail on that?
Yeah. So if we take a look at the next chart, so I went ahead and took a look at the inventory of what is possible in terms of real estate properties across the US. And one of the areas that Sherry Beckert does very well is we have a team dedicated on doing due diligence on the properties and these exchanges to ensure that our clients have access to top quality properties and fully diversified across various states. So taking a sample of what there is now available, your $500,000 investment or proceeds from the business could translate to an investment of about 8 different properties across various states: Colorado, Florida, Arizona, Texas, Virginia, Georgia, and with different types of asset, different breakdowns. It would be a combination of healthcare facilities, multifamily, triple net, single tenant. So it would be like, for example, a sporting goods store or a CVS. So that would generate about $28,000 in income. And you may recall a couple of minutes ago, you asked me about what was that $28,000 in income. So this would be annual income that would be generated from real estate holdings.
Yeah, no, this makes sense, Tessie, and just to make sure I understand it. So I could sell my building or my ownership in the building that I have with my partners right now and sell for $500,000, but it would cost me $125,000 in taxes. Or I could complete a 1031 like kind of exchange and have my building sold, but transferred the proceeds into different investment assets across multiple states in different types of properties that's diversified, and it would provide me with about the same amount of income that I'm receiving now from my ownership, which is about $28,000 per year. Is that right?
That is correct. And very important is that you would have diversification across real estate, because the most important thing to protect your assets is to diversify, whether they're real estate holdings or whether they're investable assets. So that's what we're trying to get you to. And the value of working with Sherry Beckert as well is that we continue to do the due diligence on these investments. So once you invest, we don't say goodbye. We continue being involved with you with these investments, just like the investments of your portfolio.
Okay, great.
So we talked about a second strategy for continuing to give money to the charities you feel passionate about, but at the same time be able to deduct that amount of money that you would be given over the next 10 years. So that's where a donor advised fund comes in. So think of a donor advised fund as an account where you could either deposit cash, appreciated assets, securities, real estate. You contribute it day one. You take a deduction for what you contribute into that account. You can invest it, if it's liquid and it continues to grow. But that first year, you get to take a deduction for the entire amount that you contribute. So in other words, let's say, let's talk about the 150 that you spoke about. You contribute that 150, you deduct that 150, but along the way you decide, well, that 150, I don't want to only do it across my alma mater and my church. I would also want to give to a third charity. You can make that change along the way. You select who you donate to throughout the years. So
but the key is I get the $150,000 deduction all in the year one when I have the highest tax liability that I've had relating from the sale of my business. Is that right?
Exactly. Exactly. So that's how a donor advised fund works. And the assets could be either stocks, bonds, cash, and they're invested, and obviously they will continue to grow. So as they grow, they grow tax-free, and there is a possibility that you're going to be able to donate past the 10 years because those assets will continue growing.
Okay, great.
Okay, now, one of the things that I want to do, because to me it's really important, is that we wrap up with the next steps. What is it that we should be doing? Because I know when we work on a financial plan, that's extremely valuable. However, what's even more valuable is that you implement the plan. Because we can plan as much as you want, but if we don't do anything about it, the time spent is thrown away. So one of the things we discussed about is the current portfolio that we mentioned, reducing the volatility and diversifying. We also spoke about, Linda claiming Social Security benefits at the end of the year when she turns age 66, and we're going to defer. Now, we spoke about the $150,000 in income that you're going to receive over the next 3 years. However, we briefly talked about deferring as much as we can because you're not going to need the cash. Now, one of the strategies for someone that is self-employed, like you would be as a, being a contractor to your business, to your prior business, is setting up a solo 401k. What that is a 401k similar to what you have, but you're going to be able to maximize the contributions. So out of the $150,000, you can defer up to $63,000 in taxable income from that salary that you would be receiving. So that could translate to a nice amount of tax savings as well.
Yeah, and I remember talking to Doug Cates about this. $150,000 in my particular situation was kind of the magic number in setting up the way we have the consulting income coming to me. So I know it's 1099 income, but with a S Corp designation that we put in place, it allows me to really maximize these retirement plan contributions on just 150, which is
Right.
Which is pretty great to get this amount percentage-wise in.
Right, exactly. So you're probably talking about somewhere around, $21,000 in tax savings a year, from being able to defer it. We talked about the 1031 exchange with an estimated, tax savings of about $125,000, plus the donor advised fund has estimated tax savings of about $65,000, which would be some of the, taxes that you would need to pay as well. So this can add, some of these strategies can add up to a significant amount of savings. So it would be a matter of, meeting again and meeting with Doug to start setting the plans in motion for when the business is sold. Anything that you think we've left out, or anything that I know Linda was not able to be here today, but we want to make sure that this becomes a an ongoing process in terms of financial planning, because it's not doing the financial planning today, is being able to plan on an ongoing basis. So
no, this has been great. Thank you very much, Tessie. And it's nice to see the combination of tax and wealth management services brought together and the additional value that can provide. So thank you very much. I appreciate it.
Right. Well, one of the things that we, as you know, one of the things we do at Sherry Becker is be able to not only help you on the accounting side and on the audit side, as you also found out working with our auditors, but also helping you position services as you're getting ready to sell your business as well. And I know we helped you, early on in this process. So this has really been a combination of, the services that Sherry Becker, can provide.
Great, thank you. I guess at this point, we'd like to open it up for any questions. If anyone wants to pose anything in the chat box, please feel free to do so, or contact Tessie, myself, or anyone else in the wealth management group with any questions you may have offline or after this webinar.
We'll wait a minute or so to see if there are any questions.
Yeah, and as we're waiting for that, again, thanks everyone for attending today, and Tessie and I will follow up and send you a little bit of information about Cherry Becker Wealth Management. And again, any questions that you may have, feel free to reach out to us directly, or to your CPA or tax advisor here at Cherry Becker, and we're happy to answer any questions.
Oh, we have a question. So part of the employee stock ownership plan is a strategy that can be employed as you're getting ready to plan for the future, as having your employees buy out. So it's definitely a very good strategy. In this specific case, the other partners were going to be taking over the business. However, we have teams in place through Mike DeCiato and the rest of the team that can help implement an employee stock ownership plan for the other business owners as they plan for the future and their exit. An employee stock ownership plan is definitely, I see more questions coming on. Just give me 1 second. So an employee stock ownership plan is definitely a strategy that Cherry Becker can help you evaluate as well. I see a question from Mike DeCiato on opportunity zones. Opportunity zones really provide a very good strategy for deferring part of your gains as well. So in the specific case that we discussed today, we were deferring the gains from the real estate holdings. If you want to defer, and those gains were because we wanted to diversify real estate assets. Now, if you do not need the cash for ongoing living expenses, one of the things that you can also do is you can invest in an opportunity zone where you will defer part of the gains either in the stock, in the sale of your business, and that would defer even more taxes. So let's say, for example, let's take an example. Let's say the $1.5 million that you were receiving from your business, and you wanted to say, okay, I want to invest $1 million, but $500,000, I'd like to defer taxes on a portion of that. So you can invest in an opportunity zone, and that would be deferred for a significant number of years. And whatever gains, that opportunity zone, by the way, is an investment. There were different properties and zones that were designed as the tax act that was created a couple of years ago, where you can invest in distressed properties throughout the United States. So that's another strategy to be able to invest in addition to 1031. 1031, you need to invest in real estate, real estate to real estate, but in opportunity zones, you can invest from proceeds from your business. So there could be additional opportunities for tax deferral. And that would be something that you could work with us and with your tax partner. Any other questions?
I think someone's asking a question about a solo 401k plan. Is there an age limit on forming a solo 401k plan? There is not. So as long as you have earned income, you can be over age 70 or now age 72 when you have to start taking required minimum distributions from a qualified retirement plan. You can still put a solo 401k plan in place. So it's just a really great way to save a significant amount of money beyond most other types of plans, like a SEP IRA or something similar to that, because you can typically get more money into a solo 401k with less income. And that's really the key there. And kind of in this example, $150,000 of consulting or 1099 income was ultimately able to produce $63,000 or so of annual contributions for Steve. But it opens up other opportunities as well. So we mentioned the backdoor Roth IRA early on in the presentation. With a solo 401k, you can keep that strategy in place and continue making another $7,000 contribution to a Roth. And so you're looking at $73,000 or so on $150,000 of income. So it's really just your biggest bang for your buck, if you will, in terms of what you're able to put into one of these plans. But there is no age limitation on it.
And along those lines, you know, we spoke about a solo 401k as, you know, as a potential opportunity to save taxes. Also, if you are a business owner with employees, and depending on the age of the business owner and the employees and some other parameters, there are other types of retirement plans, such as cash balance plans, that can provide a significant amount of contributions to you as the business owners, where, you know, a typical plan can save about 90% of all the plan contributions towards the business owners. So for example, if you are contributing, depending on the circumstances, but let's say as a business owner, the business is contributing $100,000 to a retirement plan, about 90% of those contributions would go to the business owner. So with the right strategies implemented, it is moving, you know, money from one pocket to the other and saving it for the future. And you are again diversifying the assets that you have in your business with the assets that you're saving with personally. And remember that everything that's in a retirement plan is asset protected. So this also covers you on the asset protection side. So
yeah, Tessie, and I'm glad you mentioned that. So what you see a lot of times, especially as business owners start ramping up or gearing up for retirement in the, you know, call it the 5 or so years before then, they want to also ramp up their savings and really kind of maximize any sort of retirement plan contribution they can make. So in a cash balance plan, so in a 401k plan, stepping back, the most you can put into it each year is about $63,000, depending on your age. And so there's a combination of factors that go in to figure out how much you can actually put in. It's based off of your other employees as well and how much they're putting in. But in addition to that amount, you can also make a contribution via a cash balance plan that would allow you to get about $300,000 in total into the combined 401k and cash balance plan. It depends on a lot of factors. It's an analysis that we can run and figure out for you. But it's huge. So a lot of people will look at the last few years of their working careers and they say, hey, I really want to maximize my retirement plan contributions. And if there's a way to put up to $300,000, you know, that's something that's very appealing to folks. all that's tax deferral as well. So they're getting complete tax deferral on that. To Tessie's point with it as well is not only do you get these large contributions in, but they're also segregated from the creditors of the company. So they're still a qualified plan. It's your own money, and we can do an analysis on it to say how much of every dollar do you put in, do you keep specifically for yourself. And when we see an analysis that says about around 75% or higher, so 75 cents of every dollar you put into the plan is yours, it makes sense. And very often we see situations where it's 90 or 95% plus of every dollar you put into a plan you get to keep. So just a huge thing that can be, very impactful, especially in those later years prior to retirement.
Right, and along those lines, you may ask, well, how do I go about evaluating, is this, will this work for me in terms of a solo 401k? And by the way, if your spouse or your significant other is part of the business, that will also be part of the solo 401k. So the contributions will also work for you and your, and your significant other. And one of the things that we work very closely with your CPA is in determining what is the highest amount that you can contribute, that you're able to contribute, and that you're comfortable with contributing. So we work hand in hand with your tax professional. Hopefully it will be your Sherry Becker tax professional to figure out the best scenario to save on taxes. So whether it be an out-zone opportunity, whether it be a 1031 exchange, whether it be a donor advised fund, or other strategies that we didn't cover today, there are a significant number of areas we can help with alongside with your CPA and other professional advisors with Sherry Becker to help you optimize your future. So with that in mind, are there any other questions that we want to cover? I think if I read correctly, I think that's it. Is that correct, Peter? Do you see any that I'm missing?
I don't see anything else either, but again, feel free to reach out to me, Tessie, anyone else in the wealth management team or someone at Sherry Becker, and happy to help and answer any questions you may have. Thanks again for attending, and look forward to talking to you guys later.
Thank you so much for the opportunity to get to share with you some of the strategies that can help you optimize your future. Thank you so much.
Thanks, Tessie.